Back to the exchange. President Trump's big, beautiful bill, that's actually what it's called, by the way. We're not editorializing, may have spooked some investors this week, but not those buying municipal bonds, as the tax exemption status for the industry remained unchanged. Your next guest says that with yields moving higher, there's plenty of opportunity out there, especially in shorter-term munis. From Allspring and Nick Venditti, he is the head of municipal fixed income at Allspring Global Investments. Nick, listen, municipal bonds, like semiconductors, are all different. You got sewer bonds in Chicago, you got state bonds in Michigan, whatever. What part of the muni bond market looks the most attractive to you and your team now?
Absolutely. Thank you so much for having me. I think munis in general look a lot more attractive just given where absolute yields are, and on a relative basis, they look very, very attractive versus other fixed income securities. I don't think investors have to take a lot of risk in this market to get a lot of yield. And with the volatility we're seeing in the longer end of yield curves, both domestically and abroad, I think it argues for keeping a little bit shorter duration, a little bit higher in credit quality, and there's some really strong revenue streams to be bought in this segment of the asset class.
From where? Like, am I buying, like I said, a sewer bond in Chicago? What am I buying?
Sure, right? I mean, look, one of the beautiful things about municipal bonds is the water and sewer system in Milwaukee, Wisconsin, where I am sitting right now, is not correlated at all with Russia and Ukraine. Right, that doesn't have any impact on our market. And so you can get very, very stable, high-quality revenue streams and a lot of yield, particularly if you're in the upper echelons of the tax bracket.
You got to do me a favor. When the show's over, I'm going to go to Cops, the one in Brookfield, right off of 94, and get yourself a burger, just for those of us who cannot, Nick. That aside, yeah, I mean, there's tax advantages to a lot of these munis. But a lot of these municipal areas are also in big trouble, right? You talked about Milwaukee. I love Wisconsin. Right down south, Chicago. These are cities. Chicago's in big trouble. I mean, how much do you need to worry? Do we need to worry at all about the ability to pay some of these debts back? Chicago just took like a $2 billion loan to pay $750 million.
You need to worry a little bit, right? I think this is a period of time where in our market, where in every market, that bottom-up fundamental credit analysis is going to be critical. But you don't need to be overly worried. And the reason you don't need to be overly worried is because in spite of the headlines, muni credits are safe. They are much safer than their corporate cousins. In fact, triple-B rated munis default less frequently than triple-A rated corporates, which means it's more likely that Apple defaults on its debt than does Chicago. That seems crazy, but there's like 150 years of history to prove that that's true.